Hello friends, and welcome to Looking at the Markets with David Modell. Today we're going to look for the holy grail in moving average crossovers, finding a way to try to avoid some of the whipsaws, the sideways chop that moving average crossover traders hate so much. We love it when the market is trending, don't we? Right? Okay. So yeah, usually with moving average crossover strategies, you're going to go long when the faster moving average crosses clearly above the slower moving average. And then you just ride it all the way up. You love this trending market, don't you? Because then you get to enjoy all this upward price action. Yep, that's where the money is made. All right. And so this is tradingview.com, and I've got 3M stock 5-minute candlestick chart. And I've got two exponential moving averages, two EMAs up there, the 9 and the 18 EMA. All right, so the orange line is the 9 exponential moving average. That's the faster one. And the blue line is the slower moving average, the 18 EMA. Okay, so yeah, that's generally how it works. All right, when the faster moving average crosses below the slower one, that's the time to get out of your long position, or possibly even enter a short position if you choose to do that. And then when the faster line crosses above the slower line, then you exit any short positions you might have had and enter a long position and ride it all the way up for profits. And then don't get out of your long position until the faster moving average crosses clearly below the slower one. Okay, and if the two lines are kind of on top of each other, you don't really do much of anything. Okay, you wait for a clear break. That's the quick version of what most moving average crossover strategies consist of. I know there are variations, but that's the gist of most of them from what I've seen. All right. And it's great because you're letting your winners run, okay? You know, you're enjoying these big run-ups. That's where the money is made. And then you're avoiding the big downturns, okay? The big waterfalls, all right? Because, you know, you get out and you might lose a little bit, but you're not losing as much as you would have if you stayed in there and took all this loss, all right? So that's the beauty of it. That's the advantage. But the big drawback of most moving average crossover strategies is when you get the sideways chop. Oh no, right? Okay. And so it's like, yeah, okay. Whenever you see it such that, here's some advertisements, whenever it's like going sideways or just kind of chopping around sideways, or whipsaws, some people call it, where you're getting in and then right after that you're getting out. Usually for a small loss, because you probably got in, up here, and then you probably got out down here somewhere, and so you take a small loss. So you get in, and then you get out soon afterwards for a small loss, and then soon afterwards you get in, and then soon after that you get out for a small loss probably, and then you get in, and then you're out. And it's really a pain because you're taking a bunch of small losses, or maybe break-evens, maybe, and then you're running up major commission costs, and that's going to eat away at your account. Unless you're using a free broker, a commission-free broker or something like that. And this is why I recommend using a low-cost, low-commission broker, or even a free, no-commission broker. That'll help somewhat. But still, a lot of these, whipsaws will cause you to take small losses anyway, even beyond the commission costs. All right, so this is where it's no fun. And you're going to encounter this probably sooner or later, probably sooner. All right. You're going to enjoy, riding it up, and you're going to enjoy the fact that you avoided the big waterfalls. But then a lot of the time, stocks and other asset classes, they're not usually trending. They're usually just kind of chopping around. And a lot of times they're just plain sideways, which is no fun if you're using a moving average crossover strategy. And so what's the holy grail? The holy grail of moving average crossover strategies at least from what I've seen, the Holy Grail, the thing that everybody's looking for, is a way to avoid this. All right, and that'll save you a lot of money on commission costs probably, and just all the small losses and a lot of aggravation. All right, so yeah, what is the Holy Grail? Yeah, I don't think there is one. I don't know any way to avoid this altogether, really. I mean, and I've watched so many videos, and I've seen websites and all kinds of things, and talked with people, and I have yet to find a really great, super reliable way to avoid this. I think it's just part of. It's just a drawback of moving average crossover strategies, generally speaking. I think you're just going to have to deal with it. You could still possibly, hopefully, make money over the long run with moving average crossovers, depending on if you do it right. Okay, and again, most of the money is made with these big up moves when it's trending. Okay. But yeah, some of that, you're going to have to cough up some of those profits when it goes sideways, probably. That's just part of it. You just have to accept it, I think. But I've collected over time, and now I'm releasing it to you guys and gals, for possible ways to at least try to reduce it. I encourage you to use demo or virtual trading, paper trading, where you're not using any real money first. Test anything out first with demo trading, virtual trading, before you commit any actual money or capital to anything. Okay, so, and do not count on any of these to work 100% of the time, because they don't. I've yet to find anything that does. But here are 4 possibilities that I've collected over time, and I want to know if you guys and gals find any of these to be useful or helpful. All right, so filtering out whipsaws, 4 possible methods. In addition, okay, so for all these, these are all separate. And so in addition to the faster moving average breaking or crossing clearly above the slower moving average, okay, so it's got to be a clear break. We talked about that, okay, like for example right here, okay, it clearly broke above it, not here, not when they're right on top of each other. Okay, so in addition to the clear break, and when I say clear break, there has to be a little bit of space between the 2 moving averages to call that a clear break. When you can't really tell if there's any space between them, I don't think that counts. All right, so but in addition to that, here are 4 filters that can help you possibly to try to filter out some of the sideways chop, the whipsaws. The crossover has to remain in effect for an additional X number of periods or candles after the crossover has started. So for example, after the clear break above, maybe you say, okay, I'm not going to get in right after the break. I'm going to wait at least 2 more candles, or 3 more candles, or 1 more candle, or whatever it is. You pick a number, you test it out with virtual or demo trading, not real money when you're testing it out. And you could decide that's when you're going to get in. And so the moving average has to stay, the faster one has to stay above the slower one for X number of candles, X number of periods after the crossover. That's one method that might work. The second one, the price has to surpass, when I say the price, I mean the candle, the closing price of the candle. The price has to surpass the faster moving average's numerical value by X% or X dollars. And those X's are numbers that you test out and fill in for yourself. Okay, when I say test out, again, virtual trading, demo trading. Don't test it with real money. All right, so you've got the crossover. All right, but in addition to the clear break of the crossover, the candle, the closing price of the candle has to be X number of percent or X number of dollars or cents, whatever currency it is, above that faster moving average, the orange line in this case. All right, so not only does it have to break, but the candle has to close, I don't know, $2 or $1 or 50 cents or 1% or 0.5%, whatever, above that faster moving average. So you're looking to make sure that it closes above, with a certain amount of momentum, I suppose, is the idea. So that's another way to do it. Here's another possibility. The crossover has to be accompanied by a significant rise or increase in volume. And so you could put the volume bars below here. And only if you get a big, tall volume bar, much taller than the previous one, in addition to the clear break, the clear crossover and moving averages, only then would you take the long side of the trade. All right. So, and that's, I kind of like that one. At least you've got some conviction or heavy trading volume along with the crossover, so that you might want to test that out with demo or virtual trading. And then finally, another possible method: the entire candle, including the wicks, not just the body, the wicks or shadows also, the entire candle has to close above both moving averages. And so you're looking for not only a little bit of space between the two moving averages, a clear break, but also you want to see the entire candle close above, like it did here. I know it's kind of small. I guess I'll zoom in a little bit, so hopefully you can see it a little bit better. But so here, when the advertising goes away, all right. So let's say, I don't know, when did it clearly break? Let's say it clearly broke, I don't know, here. Let's say you decide here. Well, is the candle entirely above the faster moving average, the orange line? Yeah, it is. Well, on the other hand, if you decided the break was here, because it kind of was, wasn't it? All right. Not the entire the entire candle was not above the faster moving average. Or maybe you see the break, the moving average crossover, and then you wait until the entire candle is above before you take the trade. Because what a shame it would have been to miss out on all this just because the candle wasn't entirely above the faster moving average, right? So that's another possibility. You're looking for some real space between the faster moving average and the candle itself, including the lower wick. All right. Now, what about crossing down below? Well, in terms of crossing down below, like it did over here, I would say just take it. Just get out. If you have a long trade and there's a cross below, I recommend don't use any filters. Just get out. Get the heck out. Because capital preservation is so important. To paraphrase Warren Buffett, rule number 1 is don't lose money. And rule number 2 is see rule number 1. All right. So in other words, more important than trying to make money is trying not to lose it, or at least don't lose a lot of it. So as soon as the faster moving average crosses below the slower one, I just get out. I don't use any filters like this. You can if you want to. You can try any of these filters, just make them reverse, kind of reverse them, right? So instead of above, just put below in all these, and then, try it that way. But for me, I like to get the heck out whenever I have a profit. So as soon as the cross under happens, I get out of my long position. All right, but that's just me. I like safety. That's important to me. Okay. All right, so I hope this was helpful to you. Again, none of these have been proven to work. I have not seen any research on these, so make your own decisions by all means. Okay. And if you want some more help, you can contact me. My email address is davidmodell@gmail.com. I do offer coaching for traders and investors, so you can email me if you're interested in the coaching. If you like this video, please give it a thumbs up on YouTube. If you have not subscribed yet, then by all means, go ahead and subscribe right now and hit that notification bell, and that way you'll get updated whenever I put out a new video like this one. I want to thank you for watching and listening to this video. I'll talk to you again soon.